Now, in this segment, we're going to start looking at, what is happening in the U.S. Is the Fed going to cut rates? Are they not going to cut rates? Because you keep hearing it, you keep seeing the market expecting some sort of big rate shift, and I thought this was interesting because you have a stress test, and so stress tests, for those that don't know, it's when the Fed or the government in some shape, way, or form goes into a bank and stresses it in such a way that they want to look at what happens in extremes. And the extremes can be in different ways. It can happen in, if you have to fire sale, what is the value of your portfolio going to be? And they try to put it through different scenarios and try to flesh out what happens in the extremes. And it's interesting because one of the things that we've been talking about since 2020, and we wrote an article about it in the beginning, I think it was February of 21, was that you were going to see rates go up and that the Fed wasn't going to be able to do anything to stop it. But yet, even though you had this movement higher in rates, when they did stress tests, none of them examined a higher interest rate environment on the bank. And I think that's very interesting when you look at how ingrained zero interest rate policy, or ZIRP, for those that have heard me say it, got so mainstream to a point where it couldn't even get into their heads that this could happen. That's scary because now you have a scenario that is playing out in real time that was never really tested. Now, again, there's ways to mitigate, there's ways to adjust, but I think that this is a very important point. So here's some quotes from the blog. In the severely adverse scenario, there is a steep decline in interest rates, which return to levels for the full 3 years of the scenario. In the immediate aftermath of the collapse of Silicon Valley Bank, some commentators noted wirily that mismatched between this 2023 stress and the actual sharp rise in interest rates over the past couple of years, which was a major factor in bringing SVB down. But it's not only for 2023 that this feature appears. Indeed, every severely adverse scenario used by the Fed since 2015 has the 3-month Treasury bill rate ending up at 0.1%. Many historic episodes of severe economic downturns have indeed been accompanied by low interest rates as the Fed used its policy tools to support aggregate demand. But it's a bit strange that not since 2015 has a stress test involved rising interest rates. And that's, again, complacency is how these things repeat. And this is why, as the saying goes, history doesn't repeat itself, but it rhymes. Because you get complacent, because you get lazy, because we haven't seen rates really meaningfully go higher since the late 70s, 80s, or 70s and early 80s. And then in 1987, you had Greenspan who proposed, essentially perpetually low rates. Now, but what happens when the liquidity builds up, when you get this pressure, and now you have to pull some of that out? And that's why when you start looking at the pressure points, it's going to be difficult for the Fed to cut rates given some of the different backdrops. And I think this is an important one. Historically, the Fed started to cut rates when core CPI was higher than current levels, but only in the 1970s and early 80s. Rate cuts have not happened when unemployment was this low. So you have unemployment at these levels, but now on the other side, when you look at it in general, you have, again, they started to cut rates in the 70s and early 80s, but now if you think about it, and we've shown this chart before, in the 70s, they started cutting rates early, which then created a bigger, faster move higher in inflation, because the view was inflation was going from 5% to 4%. And the view was we were on a downward slope that was going to continue and we were going to be okay. And it was safe to cut rates. And then instead they cut rates and it immediately exploded higher. And that was when you had Volcker that ran rates up and, to his own admission, took rates too high from where they should have been. And so he took it up to 22% and then dropped them back down. But again, in theory, realistically, when you look at unemployment rates where they are, it's going to be difficult to see some of these adjustments. And that's why and the reason why is because of wage inflation, wage price spirals. And that's a key thing that they want to try to protect against, instead of watching some of these adjustments in general when you look at some of the inflationary backdrops. So then when we take this to another level and you look at the labor shortage. So the labor shortage is still not as bad as it once was, but at the same time, when you look at job cuts, they're starting to increase. So the whole view is that you're going to get some of this meeting in the middle, and then that's going to free up the Fed to do something towards the end of the year. Our view is that inflation is still going in the wrong direction. The labor side is improving, but not to the point where they're going to have the ability, because we're still well below full employment. Full employment is what's deemed about that 4.2%. Right now, we're at about 3.8%. So again, there's still a lot of wood to chop. And then when you look at the 10-year, 2-year spread, we're at a level that when it starts to reverse higher is typically the signal that we are entering, if not already in, a recession, which again is just, when you look at what interest rates are telling us, that is pretty clear. And that's why when you look at the 80s, because this chart, I don't know, it's a little blurry, but it starts in the 70s and then carries into the 80s. And you can see that there were multiple periods of slowdowns. And unfortunately, based on the policies we've created, based on the amount of free money that has permeated the system, we believe that we're going to have a lot of these spits and starts, because we've been so irresponsible with policy for so long, and that's going to create something actually very similar to what we had in that 1980s period. Now, when we start looking at foreign buying, so foreign buying of U.S. Treasuries isn't what it used to be. But it's important to understand this. And if I had $1 for every time somebody told me that the U.S. dollar was going to lose its reserve currency status, or that the petrodollar was going away, you would not be hearing me speak right now, because I would own a massive island in the middle of the Caribbean. I would be drinking some funny drinks with pretty umbrellas, and I would be living a very happy life, because everybody talks about it. And I get there's a certain amount of consistency where if you say it constantly, eventually it'll happen. Again, it's grossly overstated. And I think somebody said it best. I was on a conference call earlier where somebody said there is transaction currencies and then there's reserve currencies. So yes, will some things be settled in yuan? Will some things be settled outside of the dollars? Absolutely. But will reserve currencies change? Will the stability of what the U.S. provides, when you look at it, and again, coming back to the petrodollar. Now, mind you, Saudi Arabia has been pegged to the dollar since 1987. They have their reserve currency is the U.S. dollar. They own and operate F-16s, F-18s. They are looking at purchasing F-35s. They utilize the U.S. Navy to protect their naval lanes. They own and operate multiple Patriot missile batteries that protect the country, as well as U.S. soldiers that operate them efficiently, because we saw what happened when we relied on them to protect them. They had a facility get attacked. So again, it's going to be difficult. The moment you can tell me what planes are they flying, what Navy protects them, what missiles protect their facilities, the moment you can answer China and all of those, I will 100% agree with you. The petrodollar is done. It's not. And it's not going anywhere anytime soon, especially when you look at the efficiencies or the effectiveness that China had against India in Ladakh. And if you look at, on the other side, the agreements that Saudi Arabia and the GCC in general have been doing with said India. So again, they're playing both sides. You have to be a politician. You have to look at geopolitics, but geopolitics is in a very broad lens. And people then point to Iran. It's like Iran has been more friend than foe to the U.S. and the West over the last 1,000 years. That is just a matter of trade. That is a matter of movements. I mean, even the Israeli prime ministers have mentioned Cyrus the Great, who is the founder, the father of Persia, who freed the Israelis from the Egyptians. He was Persian, aka Iranian. So again, you have to go back through time and look at where things were. I mean, 1979 in geopolitical terms is not a long time ago. So again, yes, I understand that China's making a splash, that, this is happening. France settled an LNG cargo in yuan and not euro. Or pump the brakes. The dollar's here. The petrodollar's here. It is not going away. I think the statistic was the yuan made up 2.5% of all transactions in energy, and I think the US dollar was 48%. Again, it's very difficult to see this, and we've seen the foreign policy that China has used. It has been a blunt instrument, and not to say that the US is an expert at it, because we're not. But you have to put this in perspective when we look at where things are. So yes, foreigners are still buying plenty of US dollar-denominated assets. They may not be buying treasuries, but they are buying US-denominated assets, just not US treasuries. So foreign demand for the dollar is still as strong as ever. The dollar, and this is the next chart here, when you look at what is being used on other credit extensions, on BTFP, on FIMA, which is the Foreign and International Monetary Authorities. When you look at these flows, the US dollar is still entering the arena. They're still the ones that are being pulled in because this is still a semblance of safety. I'm not saying it will last. Every politician going as far back as I've been alive and beyond, has done everything in their power to reduce that. And we've taken the US dollar reserve currency for granted, which is how MMT came about, which is why MMT was even created, because we took it for granted. Now we have to learn tough lessons, but if we learn those lessons properly and address this accordingly, we will still be the safety area of the world. And that's why it's going to be difficult for the Fed to cut rates, because they have to establish, we are here, we will protect the system, and we're going to protect rates, and we are going to adjust this liquidity accordingly. Yes, I understand it's going to be a tough pill to swallow. It's not going to be easy, but these are tough decisions we have to make to secure long-term growth. The Fed, which is supposed to be a non-political entity, is meant to prepare and manage the system for long-term growth, not short-term issues. And again, that's why it's very difficult. So this is just from the ANZ Research, who put together this great chart. There was an additional $41.7 billion borrowed out of the Bank Term Funding Program, BTFP, and $37 billion by the newly created FDIC Bank. The Fed's pandemic established foreign and international monetary authorities repurchase program facility was tapped for $60 billion, possibly by the Swiss National Bank. Lending out of the Fed's discount window fell to around $110 billion, but again, it had surged higher. That facility is obviously more expensive than the BTFP, as the securities used as collateral are valued at fair value relative to their latter, which are valued at par. So now when we start looking at the money market funds and what are companies and people telling you, and they're telling you that they're scared. And money market funds, is it the next bubble? Now, I am someone who worked at Morgan Stanley working on the overnight desk in the money markets fund. And I was there in 2007, where Morgan Stanley went from investing $650 billion in the overnight market to over $1 trillion, because people just wanted their money back. And that all culminated in WAMU, Washington Mutual for non-financial folk, who saw the money markets broke the dollar. So if just looking at structure, right? So structure is this. You have a money market account that's, let's say, has $25,000 in it. That $25,000 at 2 p.m., you still see it as $25,000. On the bank's end, it's zero. It has been swept into a sweep vehicle that sweeps all accounts and sends them to designated areas to get invested in overnight. And then that bank will then take their fee and give you your money back plus interest. WAMU was when you didn't get your money back. You got 99 cents of every dollar back. And that was when people realized that money markets are a risk asset. They are not a FDIC insured asset. But it's a safe place to park money, and we're seeing it again. You're seeing, and even after 2020, again, you didn't see it come down. And that was something that I always thought was odd, was because you have all these risk assets, all these assets going up in value, but there's still a lot of this money market fear, and now it's hit a new record. Money market mutual funds, when you look at institutions versus retail, you get an idea that institutions were the ones that were essentially parking this money for a rainy day, because they're like, look, we don't like what we see. There's a lot of unknown cost because of supply chains, because of everything else. We're going to preserve these assets, but now retail is starting to show fear. But again, for those who are retail that are watching this, money markets are not a protected asset. Just act accordingly. Now, when we start looking at credit crunch, it's likely that the credit crunch will intensify. And when you look at C&I loans, consumer loans, and we're getting to the point of the cycle where rates can actually come down, but you still can't get lending because, again, the standards, people or banks are going to be scared to lend. And then when you start looking at S&P 500 trailing EPS growth and ISM manufacturing going back to 1948, you can see how they're usually fairly close in line. And ISM manufacturing printed another pretty significant low, which is why we still see growth coming down, which is going to give pause to banks and the stability of some of these underlying companies. Now, the real American divide, the credit card delinquency and write-offs for large and small banks. So that we've talked about this before, and one of the big issues that we see are the small bank side and how the delinquencies are continuing to increase, and this is going to put pressure. Now, you might say, it's like, well, Mark, it's only 6%. It's like, but because these banks are showing to have fairly elevated leverage and assets that are getting cut in price essentially consistently on a mark-to-market basis, that makes even a 1% change in write-offs a magnitude problem, because then it's exponential at that point. And that's now on the upswing, leverage is great. For every dollar that you're making an extra 20% leverage. But for every dollar you lose, you're losing excess. And that's why it works in both ways. And that's where we're seeing a lot of these companies get caught. U.S. Commercial property debt, when you look at banks, they're exposed to almost 1.8 trillion on the U.S. commercial property side. Now, the problem is the small banks are the largest component of that. Close to almost 80% is small banks, and the commercial real estate area is going to struggle. Breaking out the office from the CRE in general, when you look at some of the different pieces, you get an idea of where the commercial real estate lender breakdown sits and the office property lenders sits. And a lot of it is at the regional local bank, as well as some of the other private lenders. And the private lenders are family offices. Family offices for a very long time have gotten aggressive into the commercial real estate space. And that's where we see a lot of additional problems. All the while, large time deposits, small domestically chartered banks, large time deposits have continued to go up because they're trying to entice people to come to them and stay. All the while, when you look at the real estate, again, the concentration side, when you look at the small bank side, which is that purplish line, versus the large banks, you get an idea of just the sheer magnitude of where small banks are. And look at what they've done since COVID. They accelerated aggressively the lending in this area while large banks stayed fairly flat. So again, if you think about where rates were at that time period, they were issuing new loans at record low rates at an accelerating clip. And again, that becomes a much bigger problem, especially when you go back to 2013, where you started to see small banks take over. Rates weren't exactly great at this point in time. So now you have this cycle, this problem where the rates do not cover the risk that was taken. So then when we turn to another level of the lending side of the equation is when we start looking at office vacancy side. So when we start looking at office vacancy, this is where you're going to get a problem, because we've already saw it again. There's multiple things for sale. Then it was interesting because there's an asset for sale. It was purchased by, I believe it was a Chinese entity for 410 million pounds. It's currently on the market for 250 million pounds, but the part of the collateral is in a Canadian building in Toronto. So when people think about the contagion side, so the collateral may be called in, which would then impact a Toronto building, even though it's collateralizing something that's in the middle of London. So that's where there's a lot of contagion, because a lot of these family offices, a lot of these entities were pledging capital and pledging assets in foreign nations. So again, that's where there's that kind of that connectivity that I don't think is as cleanly seen, and you can see, and again, it builds out why there's going to be some of those new problems. Newly built and occupied office space, you get an idea of the net office space absorption, which is just what is being converted into something else or what is being purchased back up, and you get this. There's a lot of newly built office space, and that is a problem where you're building new office space and your clientele is going down, which is why rents are coming down, and this is again a bigger issue going forward. Now, when we start looking at this from the spreads perspective, the 10-year versus 2-year Treasury yields has jumped by nearly 50 basis points through March. Gain only seen in recessions, which again is why we more evidence of just that recessionary drive. Now, when you look at that surge in money markets, and it's important to look at that piece of the money market assets, the Fed funds target, and typically the Fed cuts rates. But are they going to be able to do that this time? And the short answer is not yet. But all of these things are happening while the GDP growth consensus forecast is going higher. So that's where it's like you're sitting there. At least I am. I'm like, so let me get this straight. All of these things are happening, and you expect GDP to grow. It's like, okay, I'm not saying that it's going to collapse. Like, our whole thing is that we're going to get growth that's going to be negative 0.5, negative 1%. We are not saying that the U.S. is going to go down 20%. It's just, it's going to be difficult to achieve growth in this underlying backdrop. Now, when we start my favorite chart, the purchase-only house price, when you look at asset prices, they're flatlined. So when you look at the Fed, who is facing these massively overvalued assets that they created themselves, it's going to be difficult to do that. And then when you look at Kaskari, who is still shocked that he's in the position he's in, he said that 2% inflation is still the target, and that doesn't indicate that you're going to get rate cuts. And again, if they cut rates, they're going to have to worry about that red line, which is the hourly earnings, and that is going to become a bigger problem. But loan to value on aggregate household real estate holdings is fairly low because people didn't go out and buy second homes with this credit. Instead, they bought their main homes at elevated prices, but dirt cheap money. And now they're kind of stuck there. Because they can't sell because they'll never get the equity out. But if it's in a nice home in a nice area, and so now you have, which is why we think you're going to see that slowdown in new inventory unless you start to, I should say not unless, until you get that new volume coming on, which we're going to talk about in the next segment. Vacant office space in the U.S. is at the highest level in 20 years, which again, just highlighting where they are on the CRE or the commercial real estate side. Then you look at the U.S. regional banks account for 70% of all CRE loans, while the S&P real estate has lagged its parent index. You get an idea of, again, why we think that there's going to be more pressure to the downside. And just giving, again, outside of that, a backdrop of where some of these other indicators are. Brokers and carriers are both in a challenging position. Shippers are seeking lower line haul costs and expecting the incumbent carrier to deal with any fuel surcharging is declining. Spot market line haul rates, less fuel, have bottomed out while cost of diesel declines. But when you look at it, you're not seeing any real recovery because we're not seeing a whole lot of new spot rates. Spot truckload rates in the U.S. are now lower than they were in the pre-pandemic of March 2020. Costs are much higher for truckload carriers, and with rates continuing to fall, this will push much of the capacity out of the market. Spot rates are down 11%. Contract rates are down 6%. So again, this suggests that operating margins for spot carriers have moved into negative margin environment, and contract rates aren't going to, as they come up for recontracting, you're going to get more pressure, which is why we see additional downside again, because this is just showing you there's not a whole lot of movement on the general economic forefront, which is manufacturing, shipping. So again, just more pressure to the downside. So that's what we have for you on this segment. The next segment, we're going to go deeper in just the consumer and the U.S. consumer in particular.